Welcome to the Nephology podcast. I'm your host, Joe David, and I'm the founder and CEO of Nephos Group. On this podcast, we talk to founders, innovators, disruptors, and entrepreneurs from all across the globe who are building in Web3, technology, and finance. And if that's something that you're interested in, please hit that subscribe button to make sure you don't miss out on any of the latest episodes. Now on to the next episode. Welcome everyone to the latest episode of the Nephology podcast. I'm delighted to welcome Reuben Blamey to the podcast today. Reuben, how are you?
Thank you for inviting me. It's I'm brilliant. It's good to see you in person.
Yeah, you too.
So,
Thank you.
Yeah,
we've spoken a lot. This is the joy of my life now because of where I live, and obviously speak to a lot of people all around the world. I do a lot of phone calls or Teams calls or what have you, and less of this in person. So really nice to.
We're thousands of miles apart. So
exactly. Yeah. Well, not now.
No, not now.
We are actually here.
Yeah.
So yeah, thank you so much for joining. I guess let's start with who are you and what is Agant?
So co-founder of Agant, officially Agant Finance. So we are a stablecoin issuer. So one of the co-founders of that, Chief Operating Officer. So essentially we issue GBPA. So GBPA is a sterling stablecoin. So essentially in the same vein as USDC, USDT, all the sort of large stablecoins that people likely know of in the US. It's a UK-focused, institutionally focused stablecoin backed by pound sterling denominated assets. So it's entirely at the moment UK-focused. Mm-hmm. So really looking at the tokenization of the City of London and how we can sort of support that with a settlement asset that is tokenized already with being a stablecoin and also denominated in the currency that businesses in the UK and the City of London natively operate in, which is pound sterling, which I'm sure we'll get onto later as to why dollars in the UK are not necessarily the best option.
Yeah, no, and that's actually a really interesting point, that you could easily buy US treasuries and things like that, right, to do the same job in inverted commas of the reserve assets, right?
Yes.
But like you say, actually, what are you then doing? Are you actually then exposing more risk than you need to, etc.? So that's super interesting. So, so we'll come on to that. So I guess let's start with you and how you get here today. Where was your background? You did FX trading, I believe, and decentralized finance, etc., etc. So maybe tell us a little bit about your background and how you got into this.
Sure. So I'll go back to sort of when I graduated. I graduated in 2016, which now is a very long time ago. And that was in psychology. So sort of started off nothing to do with finance, nothing to do with crypto or trading or anything like this. But during my sort of second, third year of uni, I found the market. So kind of any market that moved, but it started off as FX, the most liquid market in the world. That's where sort of all the sort of the highest liquidity trading is, and it's the easiest, most like user-friendly way to get started. And then I sort of moved on from there, stayed with the FX, but also moved on to commodities trading and trading equity indices. So these are, again, liquid markets that you could spread bet. So it was actually spread betting, not trading. Okay. But it's still trading. It's just like a different way of the back office doing its job sort of thing. Yeah, okay. So I was still sort of trading markets day to day. And DeFi was like my first exploration into crypto, really. So 2017, so I graduated 2016, started trading pretty much soon after uni, and then got involved in sort of the crypto markets in terms of I saw tokens doing backflips and doing like hundreds of percent, thousands of percent. And naturally, as a trader, you're like, that's interesting. How do I get in on that? It's like, how do I get in on that? So like the risk was obviously very large, but at the time, you're completely oblivious to it. You just see, markets going up, what could possibly go wrong? So, it was buying tokens and they were doing pretty decently. They're doing 2,000% or so. And I think the first ever token I bought was XRP, so Ripple's XRP, which is still going today, still going strong. I think that did 2,000% or 2,500%. I round tripped the entire thing back down to zero. Wow. So that was my sort of first foray into like making a lot, not really technically losing it because you're losing the profit, didn't lose money, but lost all the potential gain. And then that got me interested in, okay, how does the crypto market work? I sort of understood how traditional markets worked in terms of the trading and how liquidity works and the other people in the market trading. So how does that work with crypto? Very similar. It's an order book model most of the time on exchanges. So simply I was going onto exchanges, buying tokens, and I thought there must be a better way to own these things because technically the exchange owns my token in a way. Like I'm sort of a beneficial owner of it maybe, but the actual exchange holds the token and they have sort of ownership over it. So I thought, right, how does this work? Where's the actual token sit? Which is on the blockchain, which is in a smart contract, and you can go and buy that via Uniswap or via like a sort of decentralized finance protocol where you're literally directly owning the thing. So this will feed into GBPA later when we talk about the stablecoin. Is something like an instrument that you actually, a financial asset that you literally own. Whereas even in a bank account, you don't kind of own the money in your bank.
No.
It's a claim on the bank's balance sheet.
And that's what we see that, right? You see that where Lehman Brothers is, I guess, the biggest example, right? Where you think you own the money, but actually then when that institution fails and there's a bank run, then that's when we're left.
Yes,
exactly. If you're not the quickest to the to the bullet, as it were, you're the one that's left holding the bag, and so that's something that you're conscious about changing, I guess.
Yeah, because with the tokens I was buying at the time, and what got me into DeFi was that you do own those tokens. Like it's peer-to-peer.
Yeah.
So when you buy the token and you have a self-hosted wallet, so you go and make a MetaMask wallet or a Phantom wallet on Solana, you have the private key, it's yours.
Yeah.
So when I bought the XRP, or when I bought all these other random tokens I was buying at the time, I actually held those assets and owned them. That allowed me to then go into the DeFi space and go onto protocols where I could do my own market making or my own liquidity providing. So making pretty decent returns from just putting money up to make a market to then make yield on that, which is kind of yield farming. All the airdrops were coming out, so airdrop farming. So it was kind of having it was a revolution of finance where you actually owned the thing outright. And you could be the bank, or you could be the market maker yourself.
Yeah, Aave was the first introduction to me in that, kind of in a real sense of actually this is basically just a decentralized bank.
Well, now an FCA-registered
firm. But that's what it was. I would be putting my collateral up and I would be earning off that and people would be borrowing against
You're the lender, or you're the borrower.
Yeah. So it's super interesting. So, and when you... I guess you probably disagree in this comment. You're young enough to kind of be in the forefront of the crypto market as it started to really come to life, right? Because you finished uni in 2016. You're getting into so you weren't in traditional finance for 20 years, and then you were like, "Oh, what's this new thing?"
Was never in it at all.
Yeah. So how does that? You said you traded, or spread betting, etc. with traditional markets. Was it a shift? Do you still? Say now, obviously you don't. 'Cause you're doing GBPA, but in terms of when you were getting into, did you still, or did you just completely go? Do you know what? I don't need this other?
No, I still was doing the trading. It's just that the crypto was more exciting because euro dollar, for example, let's say pound dollar, so cable, right? Huge sort of international FX trade. It's massive and it's highly liquid, but it moves maybe if you're lucky 200 basis points in a day. So 2% in a day. If you're really lucky, it'll move that much. Sometimes it'll move 0.3% in a day. Whereas you can go and trade XYZ coin, which does 30% in 2 minutes. So it's just a lot more interesting to trade. I was still doing that, sort of bread and butter was that. But then the sort of mega returns with also the mega losses / losing the returns you've just made and sort of navigating hacks and all that sort of stuff came with the crypto. So very exciting, but very risky, but the returns were high.
Yeah, the risk reward ratio was there.
Exactly.
And that's the thing I say for people about crypto is you've got to be willing to take the risk, absolutely. But if the reward is big enough, you might be willing to take the risk that comes with it. So,
exactly.
And so I guess then how did you get into GBPA? How did that come about?
So that's kind of a funny story. So I was part of these forums and these sort of groups that were searching for the best yield, right? So a yield farming group, and we would sort of talk to each other about what protocol is giving the best yield, what strategy can we use to, let's say, mitigate that risk by shorting the token you've just bought. So let's say you buy token A, you go and yield farm it, so you put it into a pool. You can then short the perpetual contract of that on an exchange. So then you're making a basis trade. So you're sort of profiting from the upside of the yield farming, but you're fully delta neutral because you sold the thing you actually also own. It was all these wild strategies that we were figuring out. So through there, so the founder of Agant, CEO of Agant, Andrew Mackenzie. So I sort of knew him as Andy, and he knew me as Reuben. We didn't know each other. We didn't know each other's faces. So it was a pseudonymous sort of knowing. And he sort of was in that group as well, and we knew each other for a while, a good while. And then Andy sort of mentioned in one of the channels of the group, he was sort of saying, I'm interested in basically doing this. He'd already started sort of the concept of Agant and GBPA. And I sort of said, I want to get involved because I see where this is going. And also stablecoins, I was using stablecoins. I was using USDT, USDC, and there was no pound stablecoin.
No.
So when I'm selling my assets or I'm operating in DeFi, I'm taking US dollar risk.
Yeah.
And that can go up and down. It can fluctuate. And also the settlement rails or payment rails on and off ramp rails, getting in and out of that is tricky.
Yeah.
You got to go via exchanges. They're taking haircuts constantly and you're getting the middleman's hands grabbing your sort of tokens. So having a pound stablecoin that you could on ramp in the UK from a UK bank and then off again sounded very intriguing, and not being able to take that sort of, not having to take the FX risk. So yeah, I sort of got in contact with Andy regarding this specifically and said, look, I want to get involved. Then I sort of intros our CTO and our other co-founder, and went from there. So
yeah, and how long ago was that?
that was, so I got involved January or the end of January, beginning of February 2024.
Oh,
So
wow. Okay.
quite some time ago now.
Oh, wow. I didn't realize
It's been
it was
2.5 years or so.
Wow.
Yeah.
Okay. Well, I mean, we can touch on the timeline. So, I guess we've spoken about Agant, we've spoken about GBPA, we've briefly said GBP stablecoin, etc., etc. But maybe there's a bigger story to it than just a stablecoin, right? So, what is it? What is a stablecoin? I guess. What is why do people care? Maybe touch on that.
Yeah, so I'll frame it before I go specifically into the GBPA part. So like tokenization is the big like word, right? So assets, so the blockchain is like a ledger. Blockchain is a ledger where it's simply in the same way as like in the olden days when like the sort of Eurodollar system and international banking started, whenever that was, 1700s, 1800s, they were literally writing in a book like, okay, you're a bank in like Liechtenstein, I'm a bank in the UK. I now owe you £1,000. That's how the ledger started. It was on a book. Whereas this is like a sort of a ledger that's decentralized, that's owned by everyone that's a participant in that particular network, which is a blockchain, and it's immutable. You can rip up a piece of paper or burn it, but you can't go back and change what blocks already been created. So it's like an immutable ledger, which is what all these systems run on. It's almost like a payment system. And then on that, you have these tokens, and the tokens can represent anything. So like, for example, Bitcoin is its own token that represents its own form of money or sort of savings asset, however you want to see it, like digital gold. Whereas a stable coin is a token that is representative of a fiat currency. And the only way you can really truly make it a true stable coin is to back it with assets denominated in that currency that are known as high quality liquid assets, HQLA. So they're like, designated as assets that are very, very safe, unlikely to go to zero, so to speak, and therefore your money, the stablecoin that represents the pound, 1 GBPA is always 1 GBP, and the other way around. So GBPA is a pound-denominated stablecoin that you can use in sort of, we're targeting institutional finance. So business use cases, institutional use cases that go from payments, settlement, collateral, FX, like settlement assets for tokenized funds, corporate treasury. So there's lots of use cases that exist already with these institutions, how they use pound sterling in the UK, which they don't use dollars, they use pound sterling because they're in the UK. That's a big point we'll get to. So that's what we're building. But we're like enabling all of the tokenization, but we're building a settlement asset for that. So if you want to go and tokenize a fund, great, but you want to settle it with something, that's GBPA. Yeah,
okay, fine. So it's not I'm not saying that you can't be using it for this, but it's not I owe you £100, and instead of sending you £100, I send you £100.
Well, it's a form of like digital cash.
It's possible to do that, but actually the story behind it is like bigger than that. As in, like what you're actually trying to do is be the settlement layer, if you like, for GBP denominated tokenized finance.
Yes, basically that's it. Because the GBPA itself is a bearer instrument or a bearer asset, which means it's the money, right? So like I said earlier, and you said as well, if you have your money in a bank account, let's say it's in bank, I'm not going to name any banks, but it's in bank A, that up to £125,000 protection. Anything above that is just a claim on the balance sheet of bank A. It's not really technically your money.
No.
So you have that claim, whereas a stable coin, you own all of it. So if you have 10 billion trillion GBPA and it's backed fully, then that is your asset. You have full ownership of that if it's in your own self-custodial wallet. And therefore, it's yours. And you can then use that in the tokenized finance that is coming up in the UK and is booming.
Yeah, it makes sense. And I think the reason I make that distinction between the kind of settlement layer for these tokenized assets, let's say, versus the payment token is, I say anyone can spin up a payment token. I appreciate it's not as simple as, I couldn't just do it. I mean, maybe these days with AI and stuff, maybe you could. But anyway, but I guess the other side to that is, why would anyone use it if that's all it is? Because if I'm talking to my dad, for example, and I'm like, well, I use GBPA, he'd be like, well, I can just send you £100 from my digital bank account to your bank account. Why would I? So I think that's why I wanted to make that differentiation, that it's not just another way to send £100. It's actually,
and for our dads, probably not.
No,
they're probably not going to use it. But it's like a business function.
Absolutely, yeah. And so we mentioned about you said you got involved in January 2024. You guys got registered under the That's why I want to
MLRs.
be
FCA registered on the MLRs.
Yeah, I've got to be careful with my wording there.
Yeah.
But that was in 2026, right?
Yeah, that was in February 2026.
So 2 years.
Yep.
What happens in that 2-year period? What's the journey like?
Yeah, lots of work. So essentially, building a stablecoin, people think is just you make a token and boom, you have a stablecoin.
Yeah.
Definitely not like that.
Yeah.
So for a start in the UK, you cannot issue a stablecoin unless you are FCA registered. And as of October 2027, it's unless you are regulated.
Yeah.
So that's one distinction to make, is that at the moment we are an FCA registered company.
Yep.
as a crypto asset business under the MLR, so money laundering registration. As of October 2027, we will need to be
Regulated.
an FCA regulated business under FSMA.
Yeah.
So FSMA is the new regime, the new regulations that are now coming out, which we've begun the process of applying for those. So if you are essentially in those 2 years, if you're wanting to just build a stablecoin, you've got a hell of a lot to do, because you have to build the relationships that span banking, asset management, all the distribution that you're going to do, what sort of model you're going to take. Are you going to go retail focused, or are you going to go business and institutional focused, which we are? So like a sort of B2B/B2B2C model. You have to build all those relationships, all the controls, internal controls. It's a ginormous amount of complexity, because we're essentially an institutional grade company, an institutional grade control and operational environment.
Yeah.
So even just getting a bank account this is an annoying thing, is crypto is a word, right? So crypto it has baggage. Theoretically, blockchain, crypto, sure, it's all a similar package, but we're a fintech company that's building a sort of new era of fintech, a bit of a buzzword thing to say, but like a new era of fintech that also involves the blockchain.
Yeah.
So it's like a new payment rail.
Yeah.
So trying to get a bank account is not always the easiest thing, especially 2 years ago.
Yeah.
When this is what you're trying to do. So it's the relationship building is massive, and that takes a long time. Finding asset managers that will provide you with the money market funds that you can use to back your stablecoin with. All of these things take a long time. So it's building the profile, it's building the trust. And it's also getting the people, right? It's getting talent.
Yeah.
So getting the right people, which I think we've done an unreal job of doing. That all the people we have are above top notch. They're brilliant. So all the employees we have and people that have joined us on the journey, those people are what make the company, right?
And persuading them to join as well, right?
Persuading them to join. It's especially 2 years ago, maybe less so now. We're FCA registered, but it was a high risk endeavor, right? It's a startup. So if you're leaving an established law firm or an established crypto firm that's already been doing business for years and saying I'll come to a startup that's a year old or less, it's tough. So it's getting the right talent. It's building all the internal controls, all of the sort of back office systems, the tech, the tech as well. What our CTO has built is brilliant. So we have our own sort of proprietary issuance and redemption platform, an entire dashboard platform that is built where businesses, once they've onboarded, can go and mint and redeem the stablecoin. But even within that, there's huge levels of complexity with all of the sort of integrations with the banks and everything. So it's building the product takes a very long time. The controls, the trust, and getting the people.
Yeah, makes a lot of sense.
Yeah.
And obviously we're obviously very excited to work with you guys and provide that kind of attestation, proof of reserves kind of model. But one thing you mentioned was you're a registered firm, not a regulated firm.
Yeah.
And that means that some of the things that you're doing today are not a legal requirement today, right?
Technically not, no.
Some of them. But they will be,
Yep.
most of them, in 18 months' time, whatever. Not quite 18 months, slightly less than that. So what was, you've obviously gone through a decision process there, and have you basically said, look, we want to act as if we are that today? Act is probably the wrong word, but we want to.
It is in a way.
Yeah, we want to show the world that we are this, even though we don't have to. Was that a conscious decision as a business to say?
It was built in kind of from the get-go.
Yeah.
I think we always knew that we wanted to be highly compliant in a way that is commercially viable.
Yeah.
Because obviously it's a business at the end of the day, you need to make money, right?
Yeah.
But you also need to try and conform with what an ever-changing, evolving regulatory landscape, especially 2 years ago when it was extremely uncertain. We've recently, I think it was last month or even earlier this month, time goes quickly, where we got clarity on what the regulations are going to be from both the FCA and the Bank of England. So 2 years ago, 1 year ago, 6 months ago, still wasn't clear, but now we know. So we were building to try and conform as well as possible to what it may be, while also doing an unbelievable amount of work, especially our Chief Legal Officer, Tom Rhodes. We did a lot of work along with Leanne Dodds, our used to be our Chief Compliance Officer, MLRO, to sort of give our opinions to the regulators.
Yeah.
And sort of say that we appreciate that you're building this regulation, but can we, as an issuer, we see issues with this part, this part, this part. Can we work with you to try and figure these out, make them a bit more appropriate to what we feel is right. Being regulated in the future means that you need to try and get ready for that now, because it's a lot of work.
Yeah. No, and like you say, it builds. You're trying to build relationships and trust with institutions, and if you're showing them we're doing everything and more than we have to today,
yes,
because we want to show you that we're that, like you say, it costs money.
It does. Time and money.
Yeah, it's not free to do these things. So you're not doing them. I say you're not doing them out of choice, but you know what I mean by that, right? You are doing them out of choice.
Yeah, well, it's also the type of business we're going after.
Yeah.
Because if we were like solely, retail has its own issues, but like if we were solely retail focused and we just want to be just on an exchange or just on as many exchanges as possible, it'd be a bit of a different setup.
Yeah.
But because we're literally trying to do business with those that are themselves highly regulated,
yes,
you really want to be seen as like an equivalent.
Almost.
So if you're going and talking to asset manager A and bank B, and your like control environment is not up to scratch, or your attestations are not even done, so like, well, how do we know what's even backing your stablecoin? You can say it, but how do we actually trust that? Having all these things in place is extremely important. Also, that attestational piece is for us very important, because people need to know what's backing it. Yeah,
and I think in the past that hasn't been understood either deliberately or not by issuers. How do you feel? Do you feel that people? I mean, from who you speak to, I guess, and what you see on the industry and stuff, do you feel people are starting to realise the importance of, in this part specifically, regulation, attestation, proof?
Yes.
Really showing the world that you are who you say you are.
Yeah. So let's take a tokenized fund, for example. So an asset manager is building a tokenized fund, and you want to use GBPA as assessment asset for the tokenized fund. You know what backs the fund, because that asset manager is regulated and that they sort of have all their transparency in place. You can see what backs it. But what backs the stablecoin, though? Like, we can say it's fully backed, but if we publish nothing, and it's like, take our word for it, like, what institutional business or corporate treasurer or whoever is going to, or like professional investor is going to use that stablecoin? So you need the transparency of, we have, let's say, 10 GBPA. Like, so you have £10. There's £10 worth of GBPA or GBP denominated backing assets backing that £10. So you know that whenever you want to, as our direct customer, you can come back and redeem that with us for £10.
Yeah.
So by doing that, we can show them what backs it. We can use, like ourselves at Nephos to attest to those reserves, to say that, this is where the reserves are held.
Yeah.
And they are segregated and also under a trust structure, which if we got time we can get into a bit later, but under a trust structure, so they're separated from Agant's own balance sheet, and that's the number that backs it, and the control environment we have around that.
Yeah, and I think we've talked. You can have your own verification process. You can have your own dashboard that shows people all of this sort of stuff.
Yep.
Fine, great, but who's to say that's true?
Yeah.
Who's to say I'm
you need a third party.
That? Yeah, you need somebody in the third party, and even going that third piece where we've said, okay, well, when we've done the report, we obviously publish it on your website, but also we'll publish it on our website.
Yep.
Because then it's a case of, it's not just something that you publish on your website and stuck our logo on.
Sure.
Like, because you can't get into it. So it's all those things really to make it that as transparent as possible, and to what I find super interesting though, right, is stable coins, like we're talking here about, everyone knows that if they've got 10 GBPA, they've got 10 GBP, blah, 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 blah. If they walk into Bank A, they've got absolutely no idea what's happening with their 10 quid, right? And people are okay with that in inverted commas.
Because it's the norm.
Because, so that's why I say inverted commas, because they kind of accept it because it's the norm. We all have money in bank accounts because that's how we transact. Slightly off topic from the specific direction of the conversation, but do you think that stable coins could replace that? Like, do you think that, you could see in the future, I'm just using GBPA as an example, but, where people, I go, for example, I don't need a bank. I can just use GBPA or whoever out USDC and, for my dollar. Sure. Do you think that's possible?
Well, it's an interesting question. I think like banks always will have their place. Like bank deposits are their own form of obviously money. It's the most recognized form of money. Stable coins, I think at the moment, serve more of a institutional focus, which I've mentioned before. About the retail part, like for example, if I wasn't anything to do with this business and I was just completely separated from crypto and stablecoins, I probably wouldn't have myself right now much of a use for GBPA or stablecoins unless I was trading crypto or I wanted to buy into a tokenized fund when they exist and when they are readily accessible. As time goes on, I think we'll see. The banks are worried, I think, well, they are worried about, and also the regulators, about stablecoins sucking deposits from the banking system.
Yeah.
They will a little bit, but there'll still be a lot of room for banks to exist. I think a lot of the stablecoin use for retail individuals might be sort of orchestrated away or like obfuscated away, so they don't need to know they're using stablecoins.
So
I think the banks will integrate stablecoins. That's the thing. It's like they know, they're starting to realize that stablecoins are now becoming a very large thing, and that the whole world is going to start operating on these rails. So they will start to integrate stablecoins into their own sort of bank accounts, that have wallets in bank accounts, so people can still have a bank account and use traditional cash, but also still then access tokenized assets.
And do you think those banks will have, let's take, I'm just going to name HSBC just for HSBC A.
Yeah.
Do you think they'll have their own, or do you think HSBC would say, right, again, actually let's partner with you and let's have GBPA on the
it's a tricky one.
Example.
No, it's not an example. So I think that there will be very few stablecoin issuers.
Yeah.
Because the thing is that, let's say every single bank in the UK and every single sort of like asset manager and institution all had their own stablecoin.
Yeah.
That's going to be a lot of stablecoins floating around. They're very difficult to issue if you are a bank because you're regulated under the PRA, so there's extra restrictions on you. But also you're then sort of having a time where you have all these different banks and all these different asset managers. Are they really going to use the other bank's stablecoin, or would they rather use an independent private issuer to sort of partner with and sort of have this like interoperable system, rather than like 30, 40, 50 different stablecoins where not going to want to use your competitor's stablecoin, you'd rather use the private issuer.
Yeah, no, that's a fair point. Yeah, you don't want to use HSBCs if you're JP Morgan, for example.
No, exactly.
And there is already starting to be the Open USD. I'm sure you saw that.
Yeah.
That was it is a consortium of.
Yes.
And there are,
I think that's what we would probably see, consortiums.
Yeah, I mean JP Morgan, I think, are involved in that in some way, and obviously Stripe are involved, and Google are involved. So that is a kind of consortium of X amount of people coming together and going, let's have this one centralized pot, if you like, that we all use and we all buy into, and
because it will touch everyone's systems and everyone can benefit. This thing, everyone can benefit from a privately issued stablecoin by someone like Agant. There's always ways that all these banks and every institution can have benefits from that.
100%. And we touched on interoperability, and we touched on people sometimes not needing to know too much about the fact that they're using stablecoins and things. So, you guys launched across 4 chains, Ethereum Base, Tempo and Solana.
Yes.
Why did you make that choice to launch across, I guess, those 4 specifically, and then why you went across 4 and not just Ethereum or whatever?
Yeah, sure. So multiple facets here. So the first thing is where is the demand? So when you go, for example, like DeFi Llama, or you go to any of these protocols that just show you where the issuance is, Ethereum has a massive amount of issuance, right? Probably it's like 70% or maybe 60, 70% of the stablecoin market. So we sort of looked at that to begin with and thought, where are stablecoins growing today? Solana was also growing and others. So it's where is the stablecoin issuance now, and where are companies, institutions, individuals already comfortable using? And Ethereum is one of those, and Solana. And then also what's being innovated on, like Tempo, for example. So Tempo is a Stripe-owned blockchain designed specifically for stablecoins. So where Ethereum might be a little bit slower, obviously it used to be a lot slower, it's got better. It's slower, more expensive. It's still very trusted, it's very centralized. But something like Tempo, which is Stripe-owned and has a lot of companies using it, and is sort of designed for this very purpose, that is also a good idea to build on that. So it's going to be client demand, where stablecoins already have demand, what chains are innovating in what we're trying to do, so stablecoins tokenization. And also, if it was only on one blockchain, you're sort of constricting all of your like usage to one blockchain. So we want to give people the ability to choose the blockchain. So we also build on layer 0, which allows us to go cross-chain natively. So that's also very, very good for firms that want to get hold of GBPA. They can go cross-chain, they can use it on multiple. And we will expand as time goes on. Yeah,
and that was going to be my next question is it fairly high level? And CTO's sitting there going, oh my God, no. Is it fairly simple for you to, if there's again, I imagine it's different. If it's an EVM chain, it's probably a bit simpler. If it's, some crazy other chain over here, it's probably more difficult. But in principle, the concept is there. It's just then, so if the demand is there, you can consider the chain.
Essentially. So it is true that like an EVM-based chain, like Base, we're on Base.
Yeah.
So Base was like easier because it's an EVM chain.
Whereas Solana was harder because it was totally different.
Yeah, you got to get sort of different smart contract audits. Like an EVM audit might cover multiple EVM chains, but like you got to go and get separate audits for each of these other chains. So yeah, I'm not going to say it's easy, but it's definitely, I think, that as a team, we've got more efficient.
Yes.
So if we do want to add another blockchain, if we have client demand or we have like a blockchain that's designing a good system and we think it's going to be good in the future, we can then work to implement that into our system and have that as an available token, I say, like more efficiently than we could before.
Yeah, no, it makes sense. And are there, side question here, but are there any rules specifically from the FCA around blockchains, but also then the requirement of you to be audited on that blockchain, or like is there anything like that at the moment in the I don't think there is from what I've seen, but
I mean, I know as part of our sort of application I think we needed an audit. I mean, that's a bit of an asterisk there. I think we did need an audit on the chains we were on at the time. It's just best practice. You need to be audited.
Of course,
But yeah, in terms of an exact specific FCA requirement, I mean, in the FSMA regime, I'm almost certain they would require you to have an audit. Right now, technically, it's an unregulated activity, but you still have to, part of the registration we did was giving the FCA the business model, and you have to explain to them what you're going to do and sort of what you how you plan to operate. And as part of that, I'm pretty certain we also had an audit at the time on the chain we were on. So,
it makes sense that you would have to. I just don't recall seeing that specifically.
No, it definitely would be there for FSMA because that's very like broad-reaching regime, and it's designed for stablecoins as well. Whereas the current regime is just anti-money laundering.
Yeah, it's just general.
Really
And on that point, I guess then of the regime and stuff, you guys have not sat back and just waited to see the rules
you can't.
you guys have been very proactive, I would say, and there's a couple of core areas that we've got here around destabilising the peg of a stable coin, or we talked about universal redemption on demand, and maybe you could talk about a few of those things that you guys have directly tried to, I say influence. I don't mean that in a negative way.
No, it's true. You do try and influence.
Yeah.
You try and give your view, because the regulators at the end of the day, they're trying to build regulation for something that's never existed before.
Exactly.
And obviously within the regulators, you have limited expertise on these systems because the people that are building them in the private market.
Yep.
So we have to give our feedback, like industry as a whole. Part of our duty really to let the regulators know how we feel about what they're saying and how can we help you to understand this better and how can we sort of give our opinions. So I think two main sort of sticking points we still have in the current regime that will come is, first thing is capital requirements.
Yeah.
So the way that the current system works with like Circle and Tether, so proven stablecoin issuance systems, where I think Tether has $180 billion of issuance, Circle $75-80 billion of issuance. These are large issuance numbers, and they work perfectly fine. They've kept their peg very well for a very long time, without the need for having. Actually, I'll start on the on-demand redemption point. Without the need for everyone having to come and redeem the stablecoin from that issuer. So, for example, Tether, they might have 300-400 million holders of USDT, but only like 800 or so direct customers.
Okay.
So you can't if I go and buy USDT from like an exchange, I can't go to Tether and say, "Oh, hi Tether, can I come and redeem $1 with you?"
Yeah.
Whereas part of the proposals here in the new regime is that we would have to, but by the rules, KYC anyone.
Yeah.
In any country, obviously, maybe not sanctioned countries, but in the vast majority of countries, they can come to us and say, "We have £1 or 1 GBPA. We want to redeem it from you," and we would have to KYC them and bring them on board.
And so you would actually, under the current regime, you would have to do that. So you would have to.
Under the regime to come, yeah.
Yeah, sorry, yeah. You couldn't say to me with my 1 GBPA, sorry.
Yeah, essentially, like it works very well already through secondary markets, so distribution markets.
Okay.
So, like currently, the sort of risk of that, the risk of a bank run, let's say. So we're not a bank, but like a bank run equivalent for a stablecoin issuer. At the moment, the risk is like distributed among distributors.
Yeah.
So it's a much safer model.
Yeah.
Because if there is like a scare or something and people want to redeem their stablecoins, they can always redeem them one-to-one. It's always fully backed. But if everyone's trying to redeem at the same time and there's like, let's say Tether had 200 million people suddenly coming to them saying, "Hey, can I redeem my $10, $50?
Yeah, they haven't got the resource for that.
Chaos, right? It's impossible. So it's done currently through a distributed risk model where you have all of these exchanges and even DeFi protocols and all these different protocols.
But effectively doing it on behalf
They're doing it on behalf of Tether. So if we had to KYC everybody, you've got to set up KYC infrastructure and sort of like do enhanced due diligence on somebody in, I don't know, let's say South Africa. We don't currently service South Africa. It might not even be in our risk appetite. So you've got to also go outside your own risk appetite. And then you have to KYC them, set up payment and banking rails in their country, maybe just to give them £1 worth of GBPA. So that proposal, we think, doesn't really make any sense because it doesn't exist now with the big issuers, and they work perfectly fine. So that's slightly odd. I think they worry about sort of the singleness of money concepts, that every money should be sort of equal for everyone. But that doesn't mean you have to always have redemption from the issuer. It can be done in other ways. And then the other point was capital requirements, where if you want to, let's say we have 1 billion GBPA in issuance, we would have to have £10 million of what's called set one capital. It's a bit of a boring topic, but it's like capital that is essentially has no preference on it, so investors don't want to give you capital that doesn't have any preference on it, and so you've got to deduct all these other sort of things from it first, and then your set one capital remains. So currently it was going to be 2% issuance in capital requirements, now it's 1%. We've sort of got better we've cut it by 50%, but it still exists. So essentially it means that we would have to have £10 million of the set one capital, which is very could be difficult to raise. I'm sure there's ways we can do that, but it's giving you more issues when you don't need them, because all of Agant's backing assets, everything that backs GBPA, is held under an English law trust. So it's a bare trust where it's completely separate from Agant's like own balance sheet. So in an event that Agant ever went bankrupt, it's okay because the backing assets of GBPA are not anything to do with Agant's own balance sheet. So why do you need a capital requirement?
I was just going to say that. It's not. It's a requirement if you're, I say, commingling, but if the funds are in.
It makes sense for a bank, right? Because banks do. That.
They don't just leave cash there; they use it to do things with. But it doesn't. But going back to the issuance point. Maybe this is a naive comment for me to make here, but if I redeem 10 physical pounds with HSBC, I don't redeem them with the Bank of England.
No.
Who are the issuer?
No. So think of stablecoins like physical cash. So you can't go to the Bank of England and say, I've got £5 in cash, can you give me £5 worth of like central bank deposits?
Correct, but they're asking you to do that under the stablecoin.
In a similar way, sort of. So we're almost like a central bank of stablecoins, like we're an issuer of money in the same way as, I'm not going to say we are like the Bank of England, but from a stablecoin perspective, we issue money in the form of a bearer instrument, like physical cash is a bearer instrument, because it literally says on the note, I promise to pay the bearer, and this is like backed by the Bank of England. So with a bank, though, you're essentially you're giving the bank your money, and it's now an asset on their balance sheet. And and if they're fully liquid and they have the capital, they can give that back to you. But you're getting it back either in cash, and obviously there's all these things going on in the background with the bank. But you're getting the bearer instrument back. Only you own that note. There's no bank that owns that note. It's you. That's the same thing with the stablecoin. You own that stablecoin.
I guess from my perspective, what I'm trying to understand is, what are they basically suggesting a slightly different rule for stablecoin issuers?
Yes, essentially.
Than they are for traditional funds.
Because even now, the Bank of England has a distribution network of banks.
Exactly.
So think of the Bank of England as the full backstop of that currency. So Agant is the full backstop in a way, or our trust is of GBPA. So we are like Clear Junction. We have a partnership with to be a distribution partner. So they're a distribution partner of GBPA and Agant. In a similar way to like a bank would be of the Bank of England, where they're the issuer and they go through them. Whereas now what they're proposing is that anyone, even if you're in another country, let's say you're in Germany, you can come to us with £1 of GBPA to us as if we're like a central bank, and say, I want you to set up all the KYC and the payment rails to give me my sort of money back into a fiat bank account. It doesn't exist like that now.
No,
it's
and that's what I was trying to get at. This is not something.
It's a tricky subject, but it's functional now.
This is not something that you're saying. Sorry, I know I'm labouring on this point, but I find it super interesting because this is not something you're saying that exists in the traditional world, but we don't agree with it. What you're saying is this doesn't really exist in the traditional world in the same context as what you're trying to make us do. So why would you make us do that thing that you don't require of the existing world at the moment? And like you say, actually, it's backed 100%, and so actually there is no risk. And
it's also under trust, so it's not even related to Agant's own balance sheet.
No. Okay, so those are the two. And how have the FCA, I guess, as an argument, how have they felt about taking on board? They've been positively.
To be honest, they have been very collaborative. Like the FCA have been good. So essentially, we've been doing all the sort of consultation responses, discussion papers. We've had sort of one-to-ones. We've been there when they've been speaking at sort of conferences, and they've actually been there when we've been speaking at conferences. And it's been a good dialogue, constructive dialogue, and they have moved on some things. They have improved the capital requirements. They have improved some of the aspects of the universal on-demand redemption. It's not as restrictive or difficult as it was before. And even the Bank of England, they've reduced the amount of unremunerated, meaning you make no yield on it, backing assets that you'd have to hold. Back in the day, it started at like 90, almost 100% of if you were classed as a systemic issuer and you're then suddenly regulated by the Bank of England, not the FCA, almost all your backing assets had to be in non-yielding assets.
Okay.
So you're not going to do a business like that because you're making no money. It's pointless. But now they've sort of reduced it much, much, much further. Okay. So both the Bank of England and the FCA have been collaborative, and we've sort of enjoyed found it useful. But there's still a bit of way to go. But the worry now is obviously FSMA is kind of somewhat set in stone.
Yeah, and it's kind of around the corner.
But things can still change, and obviously ongoing feedback will be given.
And with all these things, as well, I'm not saying what you're saying is right, wrong, indifferent, whatever, because I'm not part of the process, but you can't also expect everything you ask for to be given to you on day one.
No, because they have like legitimate concerns.
Yeah, of course.
Like this is something that's like come almost out of the blue. If you haven't been involved in crypto, all of a sudden, like stablecoins are massive, and there's hundreds of billions of dollars, and every asset manager is tokenizing their funds, and it's like overwhelming. And you're thinking, oh, we've got this like financial system that you're still thinking of 2008 and what happened then, and you're like, well, there are risks. Obviously in anything, there's risks.
Absolutely.
So I understand why they're being very, why they're concerned and why they want to be somewhat prescriptive with the rules, but they need to be a little bit more business friendly because they're currently very prescriptive.
Yeah,
they need guidelines more than like rules.
Yeah, and that's where I think touching on the UAE, but I do that quite a lot. But there is a lot of rules, but there's also a lot of guidelines on what you can, and they're business friendly. So they listen to feedback and they change and they adapt, and they whereas like you say, the UK can sometimes be a bit siloed in departments. The FCA have a department that
can be
not all the time, I actually sat on the FCA's webinar on Friday. Okay. They did one. It would have been way too basic for you given your involvement, but for me, it was super interesting to listen in, and they touched on stablecoins, and I was pleasantly surprised about the positivity and the message that they were delivering. Sure. And don't get me wrong, it wasn't the most enthralling webinar I've ever seen.
From a regulator. So.
Yeah, but it was. I came off that and I felt positive. Yeah. And I was.
Oh, you feel positive too.
Yeah, and I went into it thinking, what's this going to be like? No. I came out of it thinking, do you know what? Actually, that's not as bad as I thought it was going to be, and actually, it's much more like a lot of people talk about MiCA and it being very restrictive and very, very policy driven rather than innovation driven, and I didn't get that vibe from the FCA.
No, I think that is one positive thing about the UK is we innovate well. Like even online banking, I'm pretty sure like mobile banking was sort of a UK thing. We kind of started that here before other people did. So we've done a lot of like faster payments as a UK thing. So a lot of financial innovation has come from the UK. And the FCA are not anti-innovation. It's just that, it's like a big collaboration that is been happening and needs to continue to happen between industry and the regulators. Obviously, the one unique thing we do have in the UK is that you have the FCA, the BOE, and HMT all with their own sort of remits. And again, when you become a systemic issuer, which nobody quite knows what that means yet, HMT will designate that. You then move from the regulation of the FCA to the regulation of the BOE, which is a separate system. So we sort of have like a tiered system almost here. Yeah,
which I guess in one sense is slightly different in the UAE because ultimately anything that's related to payments or payment tokens or anything is central bank. Immediately central bank. There is doesn't matter what VARA say, it doesn't matter. Like they're the big brother in the room and they're the ones that make the rules for things like, so a stablecoin would immediately go into the central bank. So that makes it simpler in a sense, you know who your boss is.
Sure.
But at the same time, you've then got different things to navigate, which makes it challenging. So, and so we touched on this briefly around, why you focused on institution. But what do you see as the we talked about retail payments, and I guess where do you see the misconception around stable coins, and then also did that some of those misconceptions what led you to go? Do you know what institutions is the route that we want to focus on?
So I say misconceptions around stablecoins from sort of everyone in a way, and it's getting a lot better now. It's that they're crypto. So it's like our stablecoin is crypto, therefore there's loads of risk, and therefore it's volatile. So, okay, the technology is cryptographic technology because blockchain is cryptographically secured, but crypto as like an asset class is kind of more the volatile asset classes. Stablecoins is like a new financial instrument. And think of it almost as like a new payment rail. So we have faster payments and chaps in the UK. Well, blockchain and stablecoins is like another iteration again, like another improvement on those, where you have 24/7 settlement, no banking hours, and sort of the ability when you're buying and selling tokenized assets for like instant atomic settlement and DVP. So that a misconception is that stablecoins are crypto, and obviously, I see where that comes from. I would say like why we go institutional is because that is where we see the real use cases for stablecoins. If you're an individual user, so you mentioned your dad earlier, or my dad, for example, let's say they were buying some Bitcoin and they wanted to buy it with GBPA. Sure, that's a use case. So, digital asset trading is a use case, but it's just not a huge use case. Like dollar stablecoins are still very, very readily available, and they always will be. And if you're buying £100 of Bitcoin, you might not be worried that much about sort of a 0.5% interest rate difference or like an exchange rate difference. But if you're an institution and you're tokenizing a GBP share class, or you're like a corporate treasurer and you have like other company sort of entities outside of the UK, and you want to move GBP, you want to move sort of USDC or whatever sort of other currency stablecoins you have efficiently, and you're moving potentially millions, hundreds of millions, billions, you're not going to want to do that sort of just in one currency. You're going to want to keep it also in your native currency. When you're doing sort of FX using stablecoins, there's a lot of sort of like benefits there too. And all of these use cases and tokenization use cases, you want a native currency, and it's institutions that are going to be building it, and institutions are going to be using it. Now, when I mentioned about the banks sort of maybe integrating stablecoins into their accounts in the future and having wallets for individuals to be able to use stablecoins, they may not need to know they're using the stablecoins, because if they're buying like, for example, like you got Bailey Gifford that released Baggy, Archax and Govey. There's a lot of these products that are coming out, and like eventually you might be able to log on to like Interactive Investor, and there's funds on there. You don't know they're tokenized.
No,
that doesn't exist now, but like you wouldn't know they're tokenized perhaps, and you might not even know that you're using stablecoins, but you might do a bank transfer, or you buy it via your bank account, and you're technically in the background there converting it to a stablecoin. They're then sort of instant swapping into the tokenized money market fund or tokenized whatever fund it is with the stablecoin, and then back out again. But for you just see £1,000 has moved from there to there. But there's all this stuff in the background. So it's a business institutional use case based product, and like the City of London tokenizing over time, and just becoming quicker, more efficient, cheaper. All these things exist with stablecoins, and retail users will benefit from that, but maybe not like so explicitly as businesses.
Yeah, it makes sense. And we touched briefly on ClearJunction as one of your kind of distribution partners, I guess would be the kind of word for that. And what's the reason, I guess, that you guys have gone down that route of distribution partners rather than direct? If you want to call it
so that. B2B2C, essentially it allows us to access users or sort of businesses that we may not otherwise be able to onboard. It might be outside our risk appetite, or like you maybe aren't able to based on FCA guidance. So essentially, like having a distribution network, is commercially very good, because you can then access your clients.
Yeah, it's one-to-many approach.
Yeah, and it allows your clients to also improve their clients' experiences and say, look, we can, if you heard of stablecoins, we can do joint education together, for example. We can go to their clients and say, stablecoins are a thing. You might have use cases for this because you're a business. If it's B to B to C, that C may be a business, always is. So that business may have use cases for the stablecoins or for any tokenized asset, and we can do the education piece. We can then, they can obtain it via us. If we have if we're directly onboarding 1,000 businesses, we have a lot of operational compliance burdens, and again, it sort of is the whole issue of you're concentrating all the risk into yourself. Whereas not there is a lot of risk, but you're concentrating into yourself. If you have, let's say, 10 distribution partners with 1,000 customers at the end, it's all being distributed via those channels, and it's just a much better model. And if we were going for retail, you would essentially most of the time go to an exchange. and make a market on an exchange who would then, in a way, distribute it to retail. You're still going through a distribution partner.
Yeah.
I don't think many people want to be onboarding directly
with
100,000 or a million retail customers.
Yeah, I mean, we talked about Tether earlier.
Yeah,
you
don't want to be doing that. So like doing it via a distribution partner makes your market bigger, makes you this sort of distributing the sort of commercial workloads, and also just allowing those customers to also benefit from the economics of the stablecoin.
Yeah.
For example, so our sort of direct distribution partners can benefit from the economics of the stablecoin.
And are you then relying on them to do the KYC?
Well, it's their customers.
Yeah.
So essentially, we KYC and KYB the direct customer, and then that direct customer already has their customer base.
Yeah.
But also, if we want to bring, let's say we can also help them, because we say we have the business in X jurisdiction, or we have this business that is not currently your customer. We want them to onboard with you. So you now gain a customer, and we've gained a distribution channel for GBPA.
Does that, again, forgive me for maybe a naive comment, but like if GBPA therefore gets into the wrong hands, but through a distribution partner, are you still able to influence that? Like, are you still able to potentially freeze those assets? And
yeah, that's a great question. So the answer is yes. So we have a lot of good controls.
Yeah.
So blockchain monitoring, sort of real-time, ongoing blockchain monitoring, which involves sort of sanctions checks. So let's say we have a distribution partner whose customer, who is a business, buys GBPA, completely legitimate, and then they distribute. So they have customers, or maybe they're an exchange or something, and then or they're a market maker, and someone somewhere manages to get hold of GBPA, and that's like let's say someone like a sanctioned Belarusian wallet or something. That will flag real time in our systems, and we will know where that GBPA is. Like as soon as it touches that account, we know what wallet that address is linked to. And because the blockchain is an immutable ledger that you can essentially view every transaction that went anywhere, you can sort of trace those steps back. If it's like, for example, used in crime, or it's like it's used for proliferation of nuclear weapons or terrorism, all these things. There are ways that you can monitor this, and you can also then, upon a law enforcement request, let's say like the NCA requests that we freeze wallets in a sanctioned wallet, or freeze tokens in a sanctioned wallet, we have the ability via our smart contracts and our token contracts to do that.
Okay.
So we could theoretically freeze that money and say, what are the next steps?
So you're not reliant on the distribution partner to take action. You are actually able to effectively then come in and say, no, we're taking action.
Yeah, so this is one of the good advantages of stablecoins.
Yeah.
So another misconception actually is really important to talk about is that traditional money, people like cash. If I said to you, how safe is physical cash? You would say, well, I can go down the street and buy something dodgy off the bloke, right? Yeah. Whereas if it's a bank account, you've got to send it to his bank account. He's had to KYC with the bank, and it's sort of somewhat traceable. But when money starts moving through borders and through intermediary banks and intermediaries, it starts to get very, very shady and obfuscated. You can't really see what's going on.
It's kind of like a mixer, but
it's like a bit like a mixer. And that's why money laundering exists and it's so prolific. And big banks get fined tens of millions of pounds every year for money laundering, or allowing it to occur. Whereas with stablecoins, they are fully traceable. It's immutable. You do have these freeze and sometimes move controls of the stablecoin. Sure, there are, for example, the wallets, you can't see who owns the wallet because it's just an address. Yeah. And self-hosted wallets, sure, they can present their own risks, but they also have a lot of, we have a lot of controls in place to mitigate that. So it's almost like the some of the cons that someone could say are part of stablecoins or the blockchain is mitigated by the very large number of pros that actually make it quite a safe form of money, and quite a sort of enforceable form of money.
Yeah, and that's in one sense, going back to the Bank of England bank user example, the Bank of England are kind of reliant on the bank to freeze that money themselves, right? Yeah, the Bank of England can't maybe they could in a really big case,
I'm not sure.
But what I'm saying is, like you say, from your perspective, you are able to do that, and therefore you are able to control in a good way. Yeah. Then you are able to prevent, if that makes sense.
Yeah, we can. So one thing that's also important, so we don't really want to be doing that. It's not like we want to be the sort of big brother of everyone's money. Because what we are not is it's not a CBDC. Yeah. That is another misconception. Is that stablecoins are like CBDCs, that they're not. So it's not like some state-controlled, Big Brother 1984 style of money. It's just that we try and keep ourselves away from it as much as possible. We allow it to be used in the ecosystem.
But
if we're literally requested to by the NCA or SFO, whoever it is, and they say, look, we flagged it to them via like a SAR, so Suspicious Activity Report. We flag it to them and say, look, our blockchain monitoring has shown up that GBPA is held in like a sanctioned Russian wallet. What should we do? Then they will give us the instruction. Yeah. But for your average person or your average business, like 99.999% of businesses and people were not involved. Like you do what you need to do with that stablecoin.
But I think that's an important distinction to make as well.
Yeah.
So look, we're coming towards the end of the conversation. I'm really I guess fascinated to hear where you see the outlook. What do you see? Yeah. We've got. I think there's a plethora of stable coins out there. We've got dollar stable coins. Why do we need this? What's the future?
Yeah, so first on the dollar and dollar pound sort of US UK, it's almost like the world is dollars in a way. Like not necessarily the UK, but the dollar is the world's reserve currency. Yeah. Right. That's why it's like maybe 98.5 to 99% of stablecoins currently are dollar denominated. They will always be the majority. It will obviously decrease over time as stablecoins grow. But the US dollar will still be the world's reserve currency, and most things will still occur in the US dollars, especially like what they call the global south. It's like LATAM, Africa, some parts of Asia. They're still going to be operating on dollars, but pound sterling, we have a chance to export the pound sterling here, and sort of it's still the world's 5th largest currency. Yeah, and also the majority of FX trading and sort of a lot of capital markets trading is still done in London. So a lot of dollars are still traded in London, and a lot of that flow comes through our city of London. So it's almost like we still have a very important, influential global currency. And we have an opportunity by joining the tokenization race, so to speak, because it is somewhat of a race. Like if we were not doing what we're doing, and even our competitors, if they didn't exist, and no one was doing pound sterling stablecoins, and the regulators were like, oh, we're not too worried about that, we're missing out on an unbelievable opportunity here. So it's stablecoin issuers, it's the asset managers, it's the banks, it's the all the sort of capital markets institutions that are getting involved in tokenization are all helping the UK to be competitive. The regulators are helping because they are actually designing the rules in most part good regulation that gives clarity. So that's one thing that needs to continue is clarity, which we didn't have before. Now we do. So that allows us to be competitive, and we can start competing with the dollar globally because the dollar is volatile. It's not like a perfectly stable currency where there's no political risk in the US. That's an understatement. There's a lot of political risk in the US, and that will likely go on as we go forward. So essentially, it's a case where the UK has a great opportunity to export its own currency, to export its capital markets, and essentially grow the tokenization in the UK. There was a report from the Digital Markets Champion to the Chancellor very, very recently that said that tokenization can add, I think it was by 2028, it could be wrong there, 2030, can add £33 billion to the UK economy and an extra, whatever it was, 20 billion pounds of tax receipts to the Chancellor. So there he is coming up. So anything that can generate cash. Also, it creates stablecoins create demand for government debt, which is huge. So GBPA,
that's interesting.
A lot of that really backing goes into government debt, gilts and money market funds. The government is then raising money. It's an instrument for the government to raise money.
That's a really good point as well, because the UK has been less attractive in terms of buying of government debt outside of the UK, especially. So that's actually a really good point from a treasury perspective, that actually this is a positive influence on that, which at the moment there are some negative connotations towards it.
Exactly. And we are seeing businesses abroad and sort of companies abroad that do want to diversify from the dollar. Not entirely. There'll still be majority dollars, but they want to have a bit of other currency. And what better currency than, let's say, the pound sterling, even the euro, but pounds, the UK is a trusted jurisdiction. The Bank of England is older than a lot of countries. So, we have regulators that are trusted. We're seen as the gold standard in the world for compliance regulation. And the Scottish banking system or the City of London, these are proper worldwide renowned institutions that have that trust.
Yeah, and I know a lot of people, South Africa and places like that, where they want to hold funds in UK banks. As an example, right?
Especially those jurisdictions where that's a reliable banking system.
Yeah, of course, but it's also it shows how they don't want to hold it in. I don't know, something they want to hold it in pounds in a
they
bank
don't want Mexican pesos.
Yeah, exactly. Yeah. So it's definitely 100% an opportunity to, and a lot of these, I obviously live in the UAE. Dirham's pegged to the dollar.
Yeah.
I think it's 10 years that it's been pegged at the same rate, but it's not pegged to the pound, for example.
No.
Me as a British person, when I'm dealing in dirhams, that's fine if I was American because I'm kind of pegged to the same currency. I'm taking the same risk as I was holding dollars.
Exactly.
As a British person, I'm taking dollar risk without knowing I'm taking dollar risk.
Also, like your UK entity, the entity that we're now like partnered with, you don't operate in dollars because you're in the UK. You if you ever interacted with stablecoins, you wouldn't want to use a dollar stablecoin.
No, and we do. We get paid. We get paid by some people in USDC for work. And like you say, it's a problem. It's not a problem on the small scale that we do it, but in the grand scheme of things, it is a problem. And we'd much rather, and we've talked about this, we'd much rather be able to take GBPA.
Well, if you imagine the situation where you can get paid in GBPA for your services, and then immediately you can just go and buy like a tokenized fund, and your sort of like corporate treasury is yielding. And you also have the option to just stay in stablecoins fully backed by like HQLA.
And that's kind of why then I came back to the thing at the start where I said, why do I need a bank? Because for me as an individual, for someone that's in this space and believes in this concept in this space, this is a much better route for me than it is to hold money in a bank.
And we'll go forward, and you'll start to see more availability to spend stablecoins on cards as well. Yeah. So even your bank cards, you can use a stablecoin card at some point soon. It already exists in some places to tap and spend. Yeah,
and that's where one of the conversations I've had recently with one of our partners in the UAE coin, and they're looking at that journey basically around how do they ultimately the point of sale, how do they take away the friction, even to the point where if you've got Bitcoin and you want to pay for a hotel room and you don't want to send them, or not that you don't want to send them Bitcoin, but actually all you want to do is go.
This is a pain to get the massive wallet address and go and like get the gas fees.
But actually what you can do is you can go and pay in your Bitcoin, and AE coin, the company behind the stable coin, will effectively then settle that directly as dirhams in the bank account of the, so that like you say, that's where we start to really kind of combine these worlds of crypto, non-crypto, we start to converge.
Yeah. Well, two big companies that everyone's going to know because it's on everyone's bank cards that are involved in stablecoins and are sort of like building in this space, Visa and MasterCard.
Yeah.
And what do? They issue cards.
Yeah.
So like everyone's involved.
Yeah.
Like stablecoins are not like a niche thing.
No.
To the average person on the street, they probably don't know what it is. But to the financial world, this is now mainstream almost. It's becoming mainstream.
Yeah. Reuben, thank you so much for your time.
Yeah.
Obviously, we're super excited to work with you and things, because I think you're going to do some really good things. So thank you so much for giving it your time. For anyone that wants to know more about you guys and what you're doing, we'll obviously link stuff, but where's the best place to find you?
So we're most active on LinkedIn. So that's Agant on LinkedIn. So AGANT. Also agant.io. So agant.io. We post sort of like blogs on there, and we have sort of information on the stablecoin. You can also email us as well. You can message me on LinkedIn, Reuben Blamey. So we'll contact any of the team.
And if people want to kind of get involved in GBPA in terms of using it, buying it, being part of it.
Yeah, so if you're like an FCA-registered, FCA-regulated currently business institution, get in contact with us because we can onboard you and we can give you ability to mint and burn GBPA.
Yeah, so, and if you're not, then
still speak to us, because if you want anything to do with stablecoins, we'll find a way.
There's some way.
Yeah, there's a way.
Thank you so much, Reuben. Great to see you.
Thanks a lot.
Thank you.
Cheers.